The information and opinions expressed in this show should be considered as entertainment and for educational purposes only. Welcome back to StockUp episode 105. Today we're doing a new format, a video recording of the podcast. So please everyone go to our YouTube channel to watch it there. Our guest today will show us all sorts of charts, so you don't want to miss them. And of course, nothing you hear or see in this podcast should not be interpreted as investment advice. This is only for educational purposes. And this recording is done on the 28th of October. So with that out of the way, today we're thrilled to have Kevin Wadsworth, better known as North Star Chart and co-founder of NorthStarBadCharts.com with Patrick Karim. He's joining us today. And Kevin is a master at decoding capital rotation, playing the market like a chess grandmaster, pinpointing shifts in capital flows between sectors and finding good breakouts like uranium, copper, and gold. With his razor-sharp charts, he can navigate us through the battle of volatility because things are moving fast. So, Kevin, it's great to have you. Welcome.
Hi, Kenneth. Thanks for inviting me on. Looking forward to talking about what's going on in the markets because it's been, well, as usual, it's been a fascinating few weeks, hasn't it?
Yeah, most definitely. It's the world is it's going mad sometimes, but that's how it is. So could you just give a quick overview of what drew you and Patrick to co-found North Star Bad Charts?
Yeah, sure. I mean, my background is in meteorology, so I spent many years working for mainly for the Royal Air Force in the United Kingdom for the military, providing detailed atmospheric forecasts for the military for the fast jet pilots to be carrying out their missions, and sometimes in this country and sometimes across in places like Scandinavia as well, of course. So we we had many visits from aircrew from Norway and other countries, the United States. But so that kind of forecasting background that I've got, I started trying the forecasting techniques with the stock markets and with gold and silver, just to see if the same mathematical sort of numerical models that we use in meteorology and atmospheric forecasting, to see if that would work on the stock markets. And to my sort of surprise, I suppose the techniques that we use are directly applicable to the markets. So I started experimenting with different techniques for forecasting what was going to happen to the price of gold and silver and stock markets and various other things. And that's what led me to where I am today. After 34 years working for the UK Met Office, I handed in my notice, and myself and Patrick Karim, we started a website for investors. And the website uses technical chart evidence to make decisions or to help make decisions for trading and investing purposes. It's all about gathering weight of evidence, a little bit like when you're making a weather forecast, or a little bit like doctors do when they're trying to diagnose a patient. You don't just look at one piece of evidence, you look at a full weight of evidence. You do it mathematically and scientifically, and then what it tells you is not what's going to happen, it tells you what's most likely to happen. And as long as you know what's most likely to happen, then you can take advantage of that.
Yeah, that's really, really interesting. So, so what kind of analytical framework it specifically do you apply? Is like Fibonacci stuff or?
So I notice on the bookshelf behind you, you've got Stan Weinstein's Secrets for Profiting in Bull and Bear Markets, and a few other technical analysis books there. And so, myself and Patrick, we're not the first people in the world to use technical analysis. It's a well-established series of frameworks for helping to narrow down, uh, the probabilities when it comes to trying to forecast what's going to happen with the price of stocks and shares. So we use a wide range of tools, and the premise is that the more tools that you use, the more technical analysis tools that you use, the more evidence you bring to the table. And there are many times when all these different techniques give a wide variety of different answers. And when that's the case, there's a high degree of uncertainty. And when that's the case, you can't really do too much with that information. But there are also many times, during the movement of stocks and shares, where the technical analysis tends to all point in the same direction, either telling you the price is going to go up or the price is going to go down. And it's identifying those inflection points using technical analysis that is really the key to all of this. You can spot when the evidence is strongly weighted towards prices going up or to prices going down, and that, of course, is when you can take full advantage of that information. So we use things like moving averages, we use Fibonacci, as you mentioned, we use support and resistance lines, we use identification of volume by price and volume by time. We use particularly ratio charts. And for people watching and listening who don't really know what a ratio chart is, it's just where you compare two assets, one with the other, and the ratio chart or the chart itself shows you which of those two assets is outperforming. And analyzing those ratio charts and which of those two things is outperforming really does give you a very strong piece of additional evidence as to where you should be placing your capital, where you should be looking to trade and invest. And at the moment, we're at a very crucial point with precious metals and stock markets, and that's what sort of lies behind the whole thesis of capital rotation, which no doubt we'll get into a little bit more.
Yeah,
Yeah.
Kevin, uh, gold hovering just shy of $4,000 and silver pushing towards $47 and the S&P 500 notching fresh all-time highs. It's an unusual setup where risk assets and safe havens are marching in tandem. Uh, how might this convergence influence trader positioning across precious metals and equities in the near term?
Yeah, of course. Well, I think we've got accustomed to precious metals and stock markets moving in opposite directions because stock markets have been in a bull market for many years, whilst gold has really not done very much and silver's not done very much. So this idea that stock markets and precious metals don't tend to move in tandem is more of a recent thing, really. But it's not particularly uncommon for precious metals and stock markets to actually move upwards together. And when stock markets crash, of course, it's not at all unusual for precious metals to plunge with them, at least for a period of time. So there are significant periods of time when they do move together. The point that we're at right at the moment is a historic point, and I can share some of my charts to sort of explain that. If you would like me to, what other questions you might want to ask me, but I've certainly got a few charts that I can run through to help explain that.
Sure, go ahead.
Yeah, okay. Well, I'll put my screen sharing on and just give me a moment to do that. Make sure I've got three computer screens here, so I'll make sure I share the right one. So what we're looking at now is the gold and silver charts. Hopefully you can see that. The top chart is the gold chart, and the bottom chart is the silver chart. Now, if I just switch from candles to a simple line for the gold chart, what you instantly see is that the peak, this is the monthly chart. So each of the data points on here is taken at the end of the month. Okay. And it goes all the way back to the 1970s. And this is on a logarithmic scale. So the price on the right-hand side is a logarithmic price scale. Okay. So the 1980 high and the 2011 high form a resistance level with a gold chart when you carry the price forwards. And we identified this as we were approaching it in the sort of second part of last year. And we said that somewhere around that $2,750 was going to give some resistance for gold. And we had a 3 month pullback. The price fell from something like 2,750 to somewhere around about well, if I put the candles on, you can see that it dipped all the way down to around about $2,500. So there was a drop there from top to bottom, actually. It was about $380. And then the price reversed and broke through. As we know, and gold went all the way up to well over $4,000. And one of the chart patterns here that people may or may not be familiar with is something that we commonly refer to as a cup and handle. And all that means is that the price follows a cup shape, and then it follows some kind of a handle shape. You can imagine a cup and a handle on this chart. And really all it is the price falling, forming a base, and then rising again. And then it does the same thing on a smaller scale. So that's what we call the gold cup and handle pattern. And cup and handle patterns are very bullish. They're very indicative of an approaching breakout. Now, hopefully you can see the same sort of thing going on with silver here. And surprise, surprise, silver perfectly touched the upper resistance line that goes back to 2011. And if I put it on the line chart for silver as well, whoops, just let me just let's just go back there for a second. Hold on. I think oh, there we go. Okay, let me just pop this onto a line chart. Not sure if it's going to let me actually. I was trying to change that. There we go. Right. So you can see for silver that we did exactly the same thing. The high in 1980, the high in 2011, and then the price where we are now. And of course, the price has retreated from $55 all the way back down to around about 47 or so that we're at the moment. So the same chart pattern, and we can expect a similar sort of result. So the price of silver pulling back, and then an eventual breakout. And the most important thing that's going to happen to the price of silver in our lifetime is silver breaking above $55, $56. All of this that's happened here is a massive precursor, a massive sort of early stage to what's coming next. And when silver eventually breaks out above 55, 56 US dollars, then we can expect some much more extreme price moves for silver, in my view, to beyond $200 and probably closer to $300 within this bull market. Now, what's key to all of this, and this is where the capital rotation theory comes in, is the signal that we get from the stock markets versus precious metals, because the entire power, if you like, the entire impetus for the move that's coming is going to be as a result of stock markets going through a period of weakness that lasts 10 to 15 years. So we know that in the 1930s, the 1970s, in the early 2000s, stock markets experienced a decade or more without making any new all-time highs. Okay. And at the same time, gold massively outperformed the stock market. So this is the Dow Jones to gold ratio. Okay. And when the ratio is going up, it means the Dow Jones is outperforming gold. And when the ratio chart is dropping, it means that gold is outperforming the Dow Jones. Why is that important? Well, if precious metals are outperforming the stock market on a high time frame, like this is the quarterly chart. So each data point is, you only get a data point every 3 months. So if I put the candles on, each one of these candles represents 3 months price action. Okay, so when you break down on a chart that takes years and years to build out, what it's actually telling you is that you are entering a prolonged period where one or the other of these things is going to outperform. Now, the first signal came in 1929, 1930, when this ratio chart broke down below support lines, then it fell below long-term moving averages, and it fell below this red and green splodge here, which is called the Ichimoku cloud. It's a technical indicator. You asked me at the beginning, what sort of evidence do we use? Well, we use a whole range of technical indicators. This is the 8-year moving average on here. So as this chart was falling year after year after year, it meant that gold was outperforming the stock market. And that gives the power for gold to move very strongly higher. Now, of course, gold was pegged to the US dollar, but even so, they had to repeg gold 80% higher. It just shows how powerful the forces are when this happens. You then get a rotation in the opposite direction, and the stock market outperforms gold, and it did that all the way from the end of World War II all the way until the mid to late 1960s and the early 1970s. We then got another signal because this chart broke down again below the support line, below the 8-year moving average, that's the green line, and below this green splodge, which is the Ichimoku cloud. And that was a strong indication that there was going to be a prolonged period where gold outperforms the stock market. And indeed, that's exactly what happened. Gold doubled, and then it doubled again, and then it doubled again, and then it doubled again, and then it doubled again. So gold went all the way up to its peak in 1980, as we know, and had a blow off top. Stock markets began to outperform gold, and that continued all the way through for 20 years to around about 2000, 2001. And then again, the chart broke down below the support line, below the moving average, below the Ichimoku cloud. And that was a capital rotation process as capital rotated away from the stock markets towards precious metals. And we had a 10-year period where gold massively outperformed the stock market, and the Dow Jones fell over 50%, and gold doubled, and then it doubled again, and then it doubled again. So what's happening now? Well, gold has already doubled from $2,000 to more than $4,000. So we've had the first double, and we fully expect gold to double again to $8,000, and then double again to $16,000. And then we'll see how things are at that point, whether we need to raise our targets. But what's happened is the ratio has broken down below the support line, below the 8-year moving average, and below the Ichimoku cloud. And then it's also broken down below this rising trend line as well, which is very important. So what it's telling us is that even though we're likely to move back and sort of back test this breakdown, the ratio is already breaking in favor of gold, and it's moving away from the stock market. And something a lot of people don't realize actually is that the stock market peaked priced in gold 25 years ago. So gold has been outperforming the stock market for the last 25 years. Yes, we had a rally for the stock market where the stock market outperformed gold for a little while, but now it's breaking back down into a bear market priced in gold. So even though we've had the tech boom, AI, cryptocurrencies, everything that can be thrown at the markets, tech stocks, and well, this includes tech stocks, but the general stock market and the Dow Jones has not outperformed gold over a 25-year period. It peaked back in the year 2000. Now we can also take a look at the S&P. This is the S&P, gold versus the S&P. And so this is the S&P 500. And these capital rotation events, it's good to look at these rotation events on multiple charts just to make sure that we're not looking at something that's unrepresentative. We want to make sure that we look at, as I said, all of the evidence. So here we are on the monthly time frame looking at gold versus the S&P. So on this chart, when it goes up, it means gold is winning, and when the chart comes down, it means the S&P 500 is winning. So here we're looking at the 1960s and 1970s, and the ratio is breaking to the upside above the moving averages, above the Ichimoku cloud, breaking out above resistance lines, and this base formed, this sort of curved base formed, and the ratio catapulted to the upside and went all the way to a peak again, on this chart in 1980. So these are the rotations that we talk about. There's a rotation here that took place in favor of gold, and then there's a rotation here that takes place in favor of the stock markets. And the stock markets kept on winning until the year 2000. And we had another rotation. The ratio chart broke out above the moving averages, the Ichimoku cloud, and the resistance lines. So this analysis was telling us back in the early 2000s that gold was entering a period of strong outperformance versus stock markets. And that's exactly what happened. We had a massive move for gold, and stock markets fell 50% twice. In fact, the S&P suffered two drops of 50% over this 10-year period. And then we got another rotation. The chart broke in the opposite direction. It fell below support, below the moving average, below the Ichimoku cloud. And we had a precious metals bear market and a stock market bull market. And what has happened over the last 10 years is that the chart overall has gone sideways. You can see back in 2016, the chart was here, and now the chart is also here. It's at the same level as it was in 2016. So over that sort of 10-year period, 2015, 2016 to now, the ratio has gone up and down, but it's actually effectively gone nowhere. So that means that gold has matched the performance of the stock market over a 10-year period. And what's more interesting to us is that the ratio is now starting to break out above the moving average, above the Ichimoku cloud, and above resistance lines. So it's starting to give us a strong signal that there's a rotation process happening. It's not quite convincing enough yet. This hasn't broken out above the horizontal final resistance line, but at some point in the not too distant future, I think it'll become very, very obvious to everyone what's happening here. This is the Nasdaq versus gold, and again, the ratio chart peaked in March 2000. So from March 2000 to where we are now, the ratio is actually 62% lower. So since the peak 25 years ago, tech stocks have lost 62% of their value priced in gold, despite the rally that's taken place over the last sort of 10, 15 years. The ratio chart's been going up and tech stocks have been beating gold. But even after all of that, they still haven't reached the peak that they were at 25 years ago. And even worse, the chart is breaking down. It's breaking down below this rising trend line. It's breaking down below the moving average. It's broken down below the Ichimoku cloud here. So there's some kind of topping pattern going on here. It's gradually forming a top from a technical point of view and starting to break down again. So even if gold was to go back to $3,000 and the stock market continues to stay relatively strong, this ratio chart would probably only be getting back to test that resistance line there. So all of the evidence so far is telling us that we are entering a period of weakness for the stock markets priced in gold. The same thing can be said for the S&P versus silver. And actually, this is probably more of a useful chart because it helps us to get an appreciation of just how early we are in the process. Silver has gone from $14 or $15 to over $50. So it's more or less, well, it has quadrupled in price. But all of that has happened without silver massively outperforming the stock market. When this chart's going up, the stock market is winning, and when the chart is coming down, silver is winning. So it's very similar and very reminiscent of the technical chart pattern as we were in 1967, with the ratio breaking down, approaching this red major support line, which we're calling the super capital rotation event line. Super capital rotation events are incredibly rare. In fact, there's only been one in my lifetime. In fact, there's only been one in the last 100 years. Well, more than 100 years. So these events are very rare. And should we break below this rising red line in the next 2 or 3 years, then this would be the sort of opportunity that investors only will get not only once in their lifetime, but once in probably 2 or 3 people's lifetimes. So it's critical that we don't miss this. And
Yeah. Yeah, that's very, very interesting. So I was thinking, I was so surprised when I reviewed this chart and saw that there was just a regular series in the 1920s because that gold was pegged, but silver was trading quite free, wasn't it? So
it was, yeah, silver
yeah,
was trading freely, yeah.
yeah. So which like the stock market fell 87% or something is what's ridiculous, but they probably just bought gold then.
Yeah, the definition of a super capital rotation event is that we have a pattern that is built out over more. It's built out over more than one cycle, because this was one cycle here going up and then back down, and then another one up and back down again. And in doing that, it's formed a much more meaningful, very long-term support line, as we've done from 1980 to 2011 to now. So it's just a bigger pattern. It's just a larger chart pattern that's built out. And what that means is that should we break down, the implication is that the downside move is even more meaningful in terms of stock markets and precious metals. Now, of course, everything that's happened so far for gold and for this ratio for silver versus the stock market, the only reason gold and silver are outperforming the stock market is because gold and silver have done incredibly well. The stock market hasn't broken down. Nothing's gone wrong with the stock market. So the ratios moving in favor of the metals is purely because the metals have done the heavy lifting so far. The next sort of surge, the next sort of major phase is likely to come from stock market weakness. Now, there is some distance from where we are now on this chart to the super CRE line, which does give scope for silver to outperform the stock market before we get a super CRE event. So we could actually find ourselves with silver moving beyond that $55, $56 level that I spoke about, even before we get a super capital rotation event. So it could well be that silver pushes at some point beyond the 56 level to somewhere closer to, I don't know, maybe 80, 90, or even $100, and then comes back to back test the 55, 56 level in a stock market calamity of some kind. And then after that is when actually the precious metals, get their biggest moves. So everything that's happening at the moment is still going to be a build up. Just look at 1967. All of this movement in the ratio is what finally led to the breakdown into the super capital rotation event in the early 1970s. And that's when silver went absolutely crazy and rose by thousands of percent. And gold, of course, moving by many hundreds of percent, or probably even thousands of percent, I forget now, but gold moved from wherever it was at 35, 40, $50 up to 800 and something dollars. So gold went up, more than 1,000%. So this kind of move here is likely to be enormous. The sort of move that most people struggle to comprehend. And something else to remember, of course, is that oil has its biggest moves when gold is in its bull era. A bull era. So let's just take a look at this for a moment. This is the capital rotation evidence, and it's what defines a gold bull era as opposed to a gold bull market. So a gold bull market is what we're in at the moment. The price is above the moving averages. It's above the Ichimoku cloud. It's in a technical bull market, above its support levels and rising steadily in a bull market. But a bull era happens when gold is in a bull market versus all of the stock markets. And if we take a look here, so gold has put US money supply into a bear market. So USM2 is in a bear market priced in gold. The US dollar index, that's the relative strength of the US dollar versus primarily the euro, that is now in a bear market versus gold. And that's very significant. When US dollar strength is beaten by gold, that's an indication of a precious metals bull era coming our way. Consumer prices are in a bear market versus gold. Producer prices are in a bear market priced in gold. Currency in circulation, although it's going up and everybody's getting excited about how much currency in circulation is going up and USM2 is going up, it's also in a bear market priced in gold. Gold is outperforming it. The equal weighted S&P, that's what SPXEW is, that's the equal weighted stock market, if we gave all the stocks an equal weighting, and we didn't have the big stocks sort of giving bias to the stock market. Well, the equal weighted S&P is in a bear market priced in gold. The New York Composite Index is in a bear market priced in gold. The Dow Jones, as I've already shown you, is in a bear market priced in gold. The Wilshire 5000, the Russell 2000, bear markets priced in gold. The S&P is currently breaking down. It's in a process of breaking down versus gold. And the NASDAQ is also in the process of breaking down versus gold. So this doesn't have, these events, this is what I was talking about, weight of evidence. You could look at any one individual one of these things and you could kind of go, oh, well, that's kind of happens from time to time. But specifically when all of these things happen together, they've only happened in 1930, 1972, 2002, and now. So it's very strongly suggesting that we are in the midst of a capital rotation process that's going to lead to the capital rotation event. The capital rotation event is when there's a major stock market calamity of some kind, and you're only going to know it in hindsight. So we're not going to know when the stock market is in a crisis until the stock market is in a crisis. It could be next month, it could be next year, it could be in 2 years' time. We saw how long it took in the late 1960s. So, and the stock market calamity could happen all in one go. It could fall 50, 60, 70% all in one go over the course of 18 months or so. Or it could be like the early 2000s, where the stock market suffered two major events and fell 50% twice. Or it could be like the 1970s, where the stock market sort of fell sort of 30% and then recovered, and then it fell 40%, and then it recovered, and then it fell more or less 50%. So it's a sort of a series of drawdowns on the stock market. But the important thing is that in all of those cases, the stock market went nowhere for 10 to 15 years. Whatever form the calamity took, the stock market ended up going nowhere over a 10 to 15 year period. And that's what defines a capital rotation event, the stock market breaking down to such an extent that gold is in a clear bull market versus all of the stock markets. So I'm talking specifically here about the US stock markets, of course. So that is, that's the capital rotation evidence for you.
So
Yeah.
how do you view gold and silver as superior stores of value compared to traditional cash flow generating companies like miners or industrials, especially in this inflationary environment? And what are your thoughts on positioning in physical gold versus gold royalty streaming companies for long-term wealth preservation?
Yeah, so we can take a look at things like gold miners versus gold and royalty streaming companies, and they tend to do pretty well. But you have to be careful and use these ratio charts to identify when they break into a bull market versus gold, and when they break back into a bear market versus gold. So this is the Rosetta Stone to investing, because there you've only got two things that can happen. The stock market is outperforming gold, and when that happens, the stock market is in a bull market. Or you can have gold outperforming the stock market, and when that happens, gold is in a bull market. And that has always been the case for the last 100+ years. So all you need to do is identify when these rotations happen, and we've identified that we're in a rotation that is favoring gold over stock markets. So that's the first important building block. That's the key to all of this. From that point onwards, what you have to do is you measure the price of everything in gold. Don't try and forget dollars. When you're pulling up a chart, put it over gold. So if you're using a chart trading piece of software, I use TradingView. You want to look at, let's say, the price of a stock like I don't know, let's say Microsoft. You do Microsoft divided by gold, and that's Microsoft priced in gold. Now, don't buy anything if it's not outperforming gold. So now we know that gold is in a bull market. We need to make sure that whatever we're buying is in a bull market versus gold, not versus dollars, because we know dollars are being beaten by gold on the long-term chart. So with mining stocks, and we can look at GDX, GDXJ, SIL, SILJ, royalty streaming companies, price them all in gold. And if they're in a bull market versus gold, then great, invest, invest away, it's fine. But once they start breaking down into a bear market priced in gold, then that's when you want to switch back into gold. And silver is a big factor here as well, because silver is going to outperform gold in our view, moving forwards over the next several years. So silver has much more upside potential in percentage terms than gold does, and watching the gold to silver ratio is important for that as well. So a number of things going on here, but the first building block is that gold is in a bull market, and so a long-term investment in gold is something that we recommended when gold was about $1,400. So over the long term, that is the key sort of position. And then on top of that, you layer your other investments, whether it's silver, platinum, palladium, royalty streaming companies, mining companies that pay dividends, all that kind of stuff. So and we look at other sectors as well, things like base metals, copper, and the other base metals, and also energy, oil. In fact, some of the oil companies, Athabasca Oil, Shell, and a whole bunch of mining companies, oil companies that are likely to do well, and they already are doing well. So there are some signs there that energy and oil, and uranium as well, particularly the uranium sector. We've seen Cameco, which is the sector leader for uranium, having some massive moves recently. I think it was over 20% today. I don't know where this recording's going out, but some big moves. Cameco over $100 now. It's doubled in price over a relatively short period of time. So the uranium sector is another one that's we're keeping a very close eye on. But because it's kind of matching the performance of gold, so you need to look at things priced in gold, not priced in dollars. I think the stock market could continue to do okay for a while going forwards. It's actually in a sort of a melt up kind of mode at the moment. It's broken out. The S&P is doing fine, but priced in gold, as we just saw, it's not looking quite so healthy. And so regardless of the stock market and the S&P goes from 7,000 to 7,500 to 8,000, it's what it's doing priced in gold and silver that is more important.
Yeah, I think that's very interesting. And to have like when gold is a bull market, to have that as a hurdle rate for new investments is really interesting. And could you just put up the capital rotation evidence table again? Because there's two things I would like to pick your brain about, because I think especially the gold versus CPI and PPI. So that's like all the mainstream economists are saying that, well, there's no inflation now, but gold keeps going up. So what's happening when this happens? What's really happening?
Okay, I'll show you gold versus CPI and gold versus PPI. Just give me a moment to pull the chart up on the screen. Let me just, I've got a lot of charts on here. So let's have a look at XAU versus CPI. Here we go. So let me just put it on the monthly chart. So this is gold versus consumer prices. And let me just get rid of these green arrows here because we don't really need those. You can see that gold has broken out versus consumer prices back in the middle part of last year. Again, we've got a cup, handle, breakout, and a strong move to the upside. Now, when you get such strong upside moves, you expect some sort of pullback, some sort of consolidation. But the point here is that we've broken out above this major resistance line. I'll just color it in red there for you. And that breakout tells us that all of this that's been going on since 1980, all of that, and all of that has been put in the rearview mirror. So, we saw, let me just highlight here, Here we go. So this is the 1970s, and that's the kind of move that we had in the 1970s. Okay, that was one capital rotation event. Then this was the next capital rotation event from 2000 to 2011. So the current capital rotation event or capital rotation process is likely to see that kind of, well, probably significantly more than that. So something akin to the 1970s move there. So you can see that we're really still in the relatively early stages here for gold versus CPI. And the same thing for gold versus producer prices. Gold is massively outperforming producer prices. So when people talk about, is gold keeping up with inflation? And I think far too often people focus on things like that and say, oh, gold is getting beaten by inflation, or people will focus on this and say, oh, gold's going nowhere versus inflation, when in fact gold is doing that. All of these squiggles, all these up and down squiggles, gold will underperform inflation for many years, but then inflation's going on in the background the whole time, of course. So when you get a capital rotation event, gold resets its position versus inflation versus PPI versus CPI. So the fact that this chart has from 1980 to fairly recently not made any major new highs just gives us a sense of how high this might be going over the next few years, because there's a lot of inflation from 1980 to where we are now. That was the peak of the ratio in 1980. So the peak of this particular move is likely to be much, much higher, somewhere way off up here somewhere, as we price in all of the inflation that's taken place since 1980, and then probably overshoot to set us up for the capital rotation event that will come along to see stock markets outperforming gold, and then the ratio chart will come down for a long period of time. But as I say, at the moment, we're in this upwards phase where gold is repricing itself in terms of inflation. And one of the charts that I mentioned a little while ago was the equal weighted S&P versus gold. And it's worth just taking a second to look at that, because this is that chart. And it's one of the charts that gave me the confidence to say that we were entering a period of strong outperformance for gold. So when gold was around about $1,800 and this chart was just starting to break down, we started to get some significant evidence that gold was going to move up strongly, because when this chart goes down, the price of gold goes up in US dollars. And you can see the rotation taking place on this ratio as the chart breaks below support levels, below key moving averages, and below the Ichimoku cloud there. So the evidence, not just from the lines that I've drawn on the chart, but from the objective evidence, which is the moving averages and the Ichimoku cloud, they're technical indicators that the mathematics determine. It's not me putting those things on the chart, it's the mathematics. So as that ratio chart broke down below all of these key pieces of mathematical evidence, it meant that we were able to say that when gold was $28, $2,800, I should say, that it was going to move strongly higher and start trending towards $5,000. And of course, we've got to $4,300 so far. So, even though we're likely to see a significant pullback at some point, and as I said, gold could fall all the way to $3,000 or $3,500, and silver could fall to, I don't know, $35, $40. It is possible, but that is still set within the context of a much larger ongoing bull market for gold versus the stock markets.
Yeah, it's very interesting, and it's difficult to comprehend, because things are like, okay, there's a little bit craziness in the world, but it's relatively quiet, right? Because those big moves back in the 70s and also in the 20s, there were some pretty major stuff that was the cause, or well, yeah, or the effect we don't know, but but prices moved rapidly in both directions.
So it's all to do with the economic cycle. It's the business cycle. People try to attach narratives and stories to why gold is going up or why gold is going down or why cryptocurrencies are going up or cryptocurrencies are going down. Whatever it is, people love a story. Everybody loves to attach a story because it means they can get an emotional attachment to their investment, which is the worst thing you can possibly do. Don't ever get an emotional attachment to your investments. I'm not going to be emotionally attached to gold because I know perfectly well that at some point gold is going to enter a period of 10, 20 years where it is massively outperformed by stock markets and tech stocks or whatever the flavor of the month happens to be when gold has completed its bull market. So you have to use to my mind as a scientist, I have to use technical evidence to remove the bias because I love a story as much as anybody else does. But think of it this way. Think of it this way. When people say to me, technical charts are voodoo, they're just squiggles on a screen, and you need to pay attention to the fundamentals. My answer is the technical chart is the fundamentals. Where do you think the technical chart comes from? The technical chart is forward looking. Gold has been moving up, not because of something that is about something that's happening now. It's moving up because we already have the knowledge of what's coming. I'm talking here about things like interest rates. I'm talking about policy changes. I'm talking about the general macro environment when it comes to interest rates and debt dynamics. Everybody, hedge fund managers, bullion banks, they're all aware of what is coming, to a far greater degree than you and I. They privy to information that you and I will probably never know. And there's all kinds of stuff that goes on behind the scenes that we'll never know about. So the price chart is as close to the truth as you're ever going to get. You can invent a whole load of stories. You can follow your favorite people on social media that come up with stories as well. But, you know, experience has taught me that all those stories come together, the truth and the narratives and the false narratives, they all come together and the market forces are fighting each other. And you'll have investors like you and I who can't move the markets with our capital, and then you'll have the bullion banks and hedge funds who can move the markets, and all this sort of interaction of what's going on with buyers and sellers and supply and demand. Those are the stories, and the stories carve out the price chart, and it's the price chart breaking above resistance, breaking below support, giving us all of these clues and hidden clues in the ratio charts. If we pay attention to that and we learn the language of a technical price chart, we can forget about all the stories, forget about all the fundamentals. We don't need to know them. We don't need to know anything about the companies, individual companies, mining companies can cease to exist overnight, okay, for no good reason. So, you know, there are lots of risks involved in individual companies. But if you're talking about gold, if you're talking about silver, if you're talking about the GDX, if you're talking about, big ETFs, then you don't have those risks that come with small individual companies. So you can forget about those problems and you can focus on the technical evidence for the entire sector, the technical evidence for the economic cycle, and you can benefit from that. One piece of advice I would give is if you're investing, whatever you're investing in, don't put all of your NAV, don't put all of your wealth into a tiny number of micro cap companies. You're far better off not chasing the massive gains, but being content with doubling, tripling, or quadrupling your funds over a 5 to 8 year period, because that is quite achievable with relatively low risk. We've been doing that with gold and silver since 2019. Gold has moved up. It's more than doubled. Silver's tripled. So you can get 30-40% a year without all of that risk. I know people want 30 or 40% in a week these days, but if you
Yeah,
if you're
yeah.
gonna, if you're going to invest in small companies or meme stocks, then do it with capital that you can afford to lose. Think of it as a little bit of a gamble, but my advice would be to put the bulk of your capital into safer, longer term plays that don't carry the same sort of risk. But if you correctly identify the trends, you can make really, really good gains over a relatively small number of years.
Yeah, that's really really good advice. Not everyone is Stanley Druckenmiller and can do do some crazy stuff. But when we talk about like investing in stocks and the miners and royalty companies and stuff like that, so we've all seen the history in the 70s that the mining companies went crazy and had massive moves, and so that's very tempting to look into. But looking at the ratio charts, if you can pull up GDX one maybe or the silver one, and just talk about how you the reasoning behind when it's safer to put more NAV into the mining stocks versus now, or in the process where, or the phase that we are now, because like now we have seen good moves this year. It's been the leading sector in the stock market, and but they're pulling back now, and people are getting scared and maybe burnt on a few bad entries, but there are maybe good times coming, right?
Yeah, well, so you might not necessarily like what I'm about to say, but this is the gold and silver miners versus gold. So ASA is a gold and silver mining index that has over 50 years of price history. GDX doesn't go back that far. So if you're wanting to look at the long-term prospects for precious metal for gold and silver miners, then use the ASA index, or you could use the Barron's Gold and Silver Mining Index, but that's not available on TradingView. But the point here is that from 1968 to where we are now, you can see that this ratio chart has gone from top left to bottom right, which means that the gold and silver miners have underperformed gold for 55 years. Gold and silver miners have lost most of their value priced in gold. So the miners are definitely not something to hold on to for long periods of time. That's the very first thing to make clear. In 56 years, the miners lost 97% of their value priced in gold. Now there are individual miners that did significantly better than that, but I'm talking about the general overall mining indices and the sort of average of what the miners did priced in gold. But within that, there are periods where the ratio chart goes up, and you can see them highlighted here. There's one in 1972, another one in in fact, after gold and silver peaked in 1980, the miners outperformed them for a while. But during the 1970s, apart from this very short period that lasted about 2 years, the miners massively underperformed gold. And during the biggest gold bull market in history, the miners lost 80% of their value priced in gold. There were individual mining companies that did much, much better than that. But if you just bought the index and had a selection of gold mining companies, then you would have regretted owning gold miners instead of gold. The same sort of thing happened in the last gold bull era, where gold went up from $250 to $2,000, more or less. There was a period of about 3 years where the miners outperformed gold, or they outperformed and then matched gold's performance, and then they started to lose value versus gold, leading into the 2008 financial crisis, and then they plunged priced in gold. So during the 2008 financial crisis, gold went down something like 40% or something like that. I can't quite remember the number, but gold plunged something like 40%, and the miners fell even more, 60, 70%. So they massively underperformed gold and never really properly recovered. So by 2011, taken as a whole, during the gold bull market, the miners had not done any better than gold. So again, there wasn't really any great advantage to holding a general sort of basket of the miners. Fast forward to today, and you can see that the ratio chart's been moving up and has hit this horizontal breakout line that got marked on the chart, this red resistance line. And as the chart hit that level, we've seen the miners correcting, and they may well correct significantly more priced in gold and priced in US dollars before they begin to outperform again. Just how much they outperform by is open to debate, but my particular target is this black resistance line up here. And if we do get up there, that means that from where we are today, the miners would, for a period of time at least, outperform gold by about 100%, but then they would probably give it back again afterwards. So it's very, very important to be aware of these ratio charts and not just buy the miners and hold on to them throughout the gold and silver bull market. If we look at also, let's take a look at ASA versus the stock market. So this is gold and silver miners versus the stock market. And again, you can see that from 1980 to where we are now, the chart has moved from top left to bottom right. And that means that the miners have underperformed the stock market enormously. But from 2000 to 2011, the miners outperformed the stock market and outperformed the stock market by about 700%. So from bottom to top, from the point where they broke out, it was about 135% when they broke out above the Ichimoku cloud there. So, but we are at a very interesting point here, because you might have spotted that everything that's happened from 2013 to now is contained in this yellow box. That yellow box is just a basing pattern where the ratio has gone up, it's gone down, it's gone up, it's gone down, it's gone up again. And guess what? We just hit that breakout line on the top of that yellow box. And just as we hit that line, we got the correction. Now, every other time that this has happened, the ratios come all the way back down to the bottom, and the miners have given up all of their gains versus the stock market. I don't think that's going to happen this time. Could be wrong, of course, but I don't think that's going to happen this time. I think what is more likely to happen here is that we get a pullback and a breakout. But that's just my conclusion based on the evidence. But what we have to say here is that the point at which to go all in on the gold and silver miners, if you want to put it that way, is when this ratio chart breaks out, when the gold and silver miners break out versus gold, and when the gold and silver miners break out versus the stock market, then that is when you, or when they break out of this yellow box, is when we can probably expect to see them outperform the stock market by 248%, and possibly eventually more than that. If we get a big move in the miners, they could outperform the stock market by roughly 1,000% from where we are at the moment, or even more if we go back to those previous all-time highs. That's all a long way in the future, but in terms of trading and investing, you probably wouldn't want to take any action now until we get a confirmed breakout above that breakout line on the ratio chart. And that is how that's how we use ratio charts to help us. We've had some positions in the miners already, but we've limited risk. We've closed some of our mining positions with good gains, trades, and we have some open long-term positions. But if you're talking about entering a new long entry, and if you're talking about new trades for the miners, I wouldn't suggest it until we can break out above that breakout line, and that's when you get really strong evidence that the next phase is underway.
Yeah, that's interesting, and you can see it real time, right? You can just watch the ratio charts and see the truth unfold.
It's the ratio charts. Honestly, I don't know why more people don't use them. I guess maybe it's because there's a lack of understanding about how a ratio chart works and what it means. But it's really showing the hidden strength of one asset versus another. And because we know that precious metals bull markets get their confirmation by being in a bull market versus the stock market, we have to use that to our advantage. So when gold or silver or gold and silver miners are breaking out versus the stock market, that's a huge piece of underlying strength that we can use to our advantage. It's adding to this weight of evidence that it's a good time to take a position in gold and silver miners. And also, if the gold and silver miners are outperforming gold, that's an additional very good reason to start going a little bit more overweight into the gold and silver miners. Of course, if you're holding physical metals, you can't trade in and out of them. So one disadvantage of holding physical metals is that you kind of just want to buy them at the start of the bull market and then sell them at the end of the bull market. Well, if you're a stacker, you'll never sell them. Okay, I understand stackers never sell their gold and silver, but if you're doing it for a sort of a longish term investment, you want to buy it at the start of the bull market, bull era, and then sell your gold and silver at the end of the bull era, take those profits and rotate them back into the stock market. And by doing that, you never see a 50, 60, 70% drop in your portfolio, because you're riding the precious metals bull market to the upside, and then you're taking that and putting it into the stock market and riding that to the upside. Um, an event like 2008 would be challenging, and you have to use again. Um, Patrick and I, who run our website, we've taken a close look at 2008 to try and model what we would have done in real time. And when the chart breaks down below key support levels and below key moving averages, if you are able to exit gold and silver and just move into cash and let the chart play out, then that's probably the better thing to do. So if you're holding, I don't know, GLD or SIL, or if you're holding an ETF, or if you're using a service like Kinesis Money, for example, that it's basically a digitized, there are different types of digitized services where you can hold your physical gold digitally, which means you can buy and sell it in a few seconds. So if you can do that, then the best thing to do is to exit the market for a short, for a period of time, and allow the chart correction to play out, because there is a certain point in a crisis like 2008 where you don't know if that's the end of the gold and silver bull market or whether it's going to continue. Now, there were very good reasons in 2008 to suspect that the gold and silver bull market was going to continue, but in real time, that's a very difficult call to make. So it's better to protect your profits and wait for the confirmed breakout again.
Yeah. Yeah, thinking risk reward at all times is a good idea, and
Yeah, risk management is key, isn't it? I mean, you have to, you have to already have in your mind a plan, and you have to stick to your plan. So, if you're trading, you'll set your profit limit and you'll set your stop loss, and you'll have a risk to reward or a reward to risk of 3 to 1 or better. That means, you can have 50% of your trades or 60% of your trades not work out, but you can still be making a profit over time, because the one trade that does work out more than covers the two that you've just lost money on. So you can have two losers and then one winner and still be making money if your reward to risk is better than 3 to 1. So, how using that risk management on trading is essential. And then, some sort of similar idea for your longer term investing as well. You need to have a good plan for, exiting, because that's more just as important as getting a good entry point, is making sure you time your exit well without giving back too many of those gains.
Yeah, and I think that's like when you have a 10-year bull market with I don't know, like 20, 30 percent drawdowns, the occasional 20, 30% drawdown, you really don't need to sell. But if it's 50, 70, 80, then you're gonna sell at the bottom. Yeah,
Yeah,
100%.
buying near the top and selling near the bottom is it's a trap that so many people fall into, because it's hard to buy when it doesn't feel right. I mean, would it have felt right to buy gold in 2019? I don't think many people were looking to buy gold when it was 13, $1,400 and had gone nowhere for many years. Um, you know, it, it's human psychology, and that's where the technical chart evidence can help you to overcome those things. It allows you to take an entry, not right at the very bottom, selling at the very top and buying at the very bottom. Forget that. Forget it. It's pretty much unachievable. You're catching a falling knife, and even if you think you're hitting a support level, support levels break in bear markets, and the price moves lower and then lower and then lower. So trying to catch the bottom is not, in my view, the way to do it. The way to do it is to buy breakouts. Let the chart give you some evidence that there's some strength developing there. Once the chart has proven to you that there's some strength developing and it's capable of breaking some upside resistance, then you're talking. Then you can actually use that to your advantage and get in, not at the bottom, but at the one of the early breakout levels. And there's a whole load of different techniques for helping to identify that. Things like distance from moving average, how far price is stretched from its moving average, can help identify really good entry points.
Yeah, excellent. So I think we're on the hour here now. So thank you very much, Kevin, for your insights on gold and this capital rotation thesis. I think that many people need to look into. How can people get in touch with you if they want to learn more?
Yeah, sure. Well, you can find me on X if you've got an account on X. I'm at North Star Charts on X, and you can also find me on our website, the website that I run with Patrick Corinne, which is northstarbadcharts.com. And of course, it's coming up to the my mind's going about Black Friday. I'm I'm thinking of Halloween and all sorts of things here, but it's Black Friday coming up soon, and we'll be giving some very good special deals with discounts and that sort of thing. So if you fancy trying us, give us a try, and if you don't like us, you'll get your money back. So yeah, nothing ventured, nothing gained.
Yeah, that sounds good. So we'll include all those details in the show description, and yeah, I've only have good words to say to you guys. I've been a happy subscriber for a few years now, and yeah, thank you very much for your time again, Kevin, and hope we'll speak soon.
Thanks, Farouk, and yeah, thanks Kenneth as well. Nice to talk to you.
Likewise, likewise.